Also, does anybody know what Monday marked the 3rd anniversary of?
Gainesville office.
Gainesville office now. TARP. The $700 billion TARP deal went into effect 3 years ago on Monday. What happened to bank stocks on Monday? The major bank stocks. They tanked. They all tanked. Isn't that kind of funny?
Yeah.
Well, Chase was down the biggest, 9.7%. Bank of America was down 9.6%. Wells was down. They all dropped on that day. It's just kind of weird how that all came about. But the other things that are interesting are out there. Big banks could also stand to lose billions of dollars if FHA seeks indemnification on the claims. They're going back to the banks and they're saying, hey, you guys underwrote these bad loans. Why should we pay you for underwriting these bad loans? So there's plus the other reason that FHA is doing that is FHA's position right now is not very strong. They only have $4.7 billion against $1 trillion portfolio. So their reserves are low, and that's another reason why they're looking at these banks more closely as to whether or not they're going to pay those insurance claims to them. So this could come into effect when we're dealing with short sales, right, John? I mean, if the bank is not going to get reimbursed for the insurance, then they may not approve that short sale. And so it could have an impact. It's just something that came out on the 4th, which is yesterday. So something that we need to kind of keep a mindful eye on. And I don't know how it's going to affect the foreclosure process or not, because when a bank goes into foreclosure on a property, do they get FHA money then, or is it only when they do a short sale that they get money?
I think they stand to get money on both.
On both.
On both.
So it'll be interesting to see what happens with those things. Yes, Laura. No, Jason.
I'll do Jason first.
Okay.
I was just gonna say, and this might be a question for Phil too. I mean, like we saw last week, where Bank of America may or may not be getting out doing loans altogether. Do you think that the big banks are pushing the business towards correspondent lenders that add more of a layer of coverage because they're really more liable for underwriting those loans?
Well, it's interesting you say that. Actually, we heard 2 days ago Bank of America is getting out of the correspondent business, and actually today is the last day that we can lock it with Bank of America. So,
but are they getting out of mortgage lending altogether?
I don't know that. They're getting out of correspondent lending, and if you don't know what correspondent lending is, like we're a correspondent lender. We have relationships with all the major banks. Well, I say all, many of the major banks, and then they give us complete autonomy to process, underwrite, prepare the closing documents, and fund the loan at closing. And then after closing, the loan is sold in the secondary market to those investors for servicing. So Jason's point is right, and to speak to what you're saying, Scott, when a property is foreclosed on, one of the first things that the lender, the bank, will do is take a look at that loan and figure out if there's any reason at all they can send it back to the correspondent lender, us, and blame us for the reason it went bad. And that happened a lot early on in this process. Now, for the last year and a half, 2 years, underwriting standards have been much more strict, and so the likelihood of originating and closing a poorly done loan is really stopped or trimmed down tremendously. That doesn't mean there aren't people out there still doing illegal things, but there's two schools of thought on the whole correspondent thing. The big banks getting out of it and keeping it for themselves and managing everything just themselves. But like you said, once you do that, then they're the ones on the hook. Whereas when they go the correspondent route and they can have that level of security between the loan and themselves through the correspondent, that does enable them to mitigate some of their risk. So I would say that's the more likely scenario and what we're seeing. And as you all know, lending guidelines have gotten tougher and more strict, but we've seen some relaxing in certain areas. The mortgage insurance companies are getting much more relaxed in their guidelines. So overall, we're producing better loans, and so I think the likelihood of them going bad has diminished. And so the true foreclosures that are happening now are the ones that are because of probably real fraud kind of things, not just pushing bad loans through because the people didn't really qualify.